Hello, today I want to talk about the CAPE ratio again, this cyclically adjusted price to earnings ratio, otherwise known as the Shiller PE, the Shiller CAPE ratio, the PE 10 ratio. Now, if you want to check out previous videos, follow these links here. Now, in the last one there, we talked about the fact that the US is way up there. It has really high CAPE ratios right now, and that subsequent returns starting from a high CAPE ratio are typically bad. So the question is, given that US is so unattractive based on this measure right now, where else in the world should we be looking to invest our money in the stock market? So also want to mention that I am highly critical of using price to any kind of metric, price to earnings. We should flip that around, earnings to price. There's distortions when you have the price in the numerator, but we're going to keep it at PE or CAPE today because of some of the data that I have, just too time consuming to switch that around. So as a reminder, here's the chart, a little bit of it's cut off, but the idea here is the lower the CAPE ratio, the better the future returns, and the higher the CAPE ratio, the worse the returns. And this is true throughout the world here. So if I want to think about where are the bargains right now, well, let's look in that 0 to 8 bucket and that 8 to 12 bucket. Again, we're not capturing the distortion of the PE ratio here, but it is there. So these buckets aren't really as equal as they seem because it's not linear, but you can look at the other videos to check that out. So anyway, where are the 0 to 8? So if we look right now, these are the countries where the CAPE ratio is below 8. So this is Russia, Turkey, Poland, Czech Republic. And you think, Ryan, wow, this is crazy. I'm not going to invest in those countries. Well, that's the whole point. That's why they're attractive, because people don't want to invest in them. But that's where you want to go. You want to go where the fear is. You want to go where no one else wants to go. Your returns typically are better when you do that. All right. What about that 0 to 12 bucket here? So we get Austria, Spain, Singapore, Hungary, United Kingdom. We have some countries that maybe you're a little more comfortable with, but again, we're in this lower range of starting CAPE ratios. These are places to look for bargains when you're investing. And maybe I'm not saying, hey, pick one of these. Maybe you want to pick all 9 of these and equal weight them, and you'll have a better chance of outperforming if you put all that money in the US stock market. Even though it may be uncomfortable, these are the types of places you typically and generally want to be. Now, another thing you should consider is, like, why only consider earnings? Why not consider other metrics? So if you think about PE or earnings yield, you think about dividend yields, cash flow yields, book to price. Again, these are with the price in the numerator, but I say flip them around when you actually do the analysis. When you have all the data there, I was just using kind of publicly available data here. And then I said, well, what if we rank these, countries by each of these metrics, and then kind of take an average rank? If we do this, we're going to see, Poland, Czech Republic, Russia being the most attractive on an average basis. They are emerging markets, and then we can see some developed markets pop in there. Now you think, well, I don't want to be in emerging markets. That's crazy. Well, the thing is, when the emerging markets are hot, everyone wants to be in there. That's where all the growth is. So keep that in mind here. I think we have some attractive countries here, some attractive valuations, and history is certainly on your side, even if there's a chance that it won't repeat. I think in the long run, if you're looking out 5, 10, 15 years, these are better options for you than the extremely expensive US market right now. So happy investing out there. Do what you want. Don't take my advice. Do your own analysis. But this is food for thought based on history and based on what we're currently seeing right now. Thanks so much for listening.